Hello everyone, welcome to another episode of Firm Returns Weekly. This week, we're going to be digging into the Warner Bros. Discovery Q3 earnings. I'll just share my screen quickly. So, we've also got some positive news about the strike to cover a little later on. Let's dig into the earnings. So, on Wednesday, the 8th of November, Warner Bros. Discovery published their Q3 earnings covering the period ending 30th September. Overall, I came away pretty positive, but it seems that the market may have disagreed. So I think it fell something like close to 20% on the day of the results, so down to sort of here. And it's since sort of recovered. I think part of that recovery is probably to do with the strike just afterwards, probably around about here. It was announced that the resolution to the strikes was on the table, was in place and tentatively accepted, and then it would be fully verified and approved and so on Friday, which is the 10th. So yeah, that probably is something to do with the swing. But this large drop, as I'll get on to, largely I think to do with the ad market. Let's have a look. So there's been quite a lot of talk about fears of a weak advertising market in 2024, but as far as I can tell, the forward guidance given by management factors that in and still leaves the company in good shape. In any case, let's dig into some of the financials. So I've got a link here to their quarterly results page that's got the different things, presentations and so on. There'll be a link to the earnings call recording and everything. So give that a look if you want to dig into it in more detail. So revenues were pretty well flat at $9.98 billion versus $9.82 in Q3 2022, but adjusted EBITDA rose 22% to $2.97 billion from $2.42 billion. Looking at the breakdown of costs on the income statement, we can see that they have come down meaningfully across all categories. Part of this will be due to the impact of the strikes, but there are clearly some synergies starting to come through. I think they talked $4 billion of synergies or whatever have already been realized up to this point, though they've had to spend money to get them. So that would be like in future years, you really see that, and they've scope for more than 5 in total. So there's that sort of scope for further synergies just keeps growing. But yeah, we'll dig into a second. You can really just see everything as across all the cost of revenues come down, I guess. And these are things going to be, some of it, like I say, is going to be the impact of strikes, not paying as much for certain things and so on. But, they're able to optimize marketing, which will be, I guess, to come in under SG&A and stuff. And then you've got cost of revenues, just optimizing the content spend, just optimizations across the board. Because we know that Discovery was a very efficiently run company prior to the merger, so they've been able to bring some of those cost efficiencies to bear at Warner Media, which wasn't so cost efficient. So yeah, they're bringing a lot of that focus on cash and so on to the biz. And yeah, and obviously the restructuring charges here as another big component that's dropped off, but that's just going to be, that can't really be factored into the ongoing stuff. This is like a one-off drop, really, just because of the money they were spending last year to really implement the changes and so on they wanted from the merger. And yeah, so this line kind of can be excluded for in future years. But yeah, so the improved cost efficiencies and a lower level of restructuring and other charges led to a positive operating profit of $97 million compared to an operating loss of $2.19 billion in the Q3 of 2022, and a significantly reduced net loss of negative $407 million versus negative $2.29 billion. And Yeah, so it's and the interest expense I think crept up slightly. I'm guessing that's because of the there's still a component of variable rate debt in there that's tweaked up a little bit, even though they have been paying the debt down. But the variable rate is what they're targeting, obviously, is priority to remove. So use on the, I think they've still got some like SOFR plus whatever rated debt, so that stuff will still be trending up or down, whatever with things. But yeah, moving on to the debt. Well, yeah, I think just overall here, it's things are looking positive, in the moving in definitely in the right direction. And we'll get on to cash flows and so on, where the picture is looking even rosier. Obviously, here we've got a lot of depreciation and so on that you don't really see in the cash flows and things. Yeah, let's move on to the debt. So gross debt at quarter end was $45.3 billion after a further $2.4 billion was repaid or repurchased on the market during the quarter, and the company had $2.4 billion of cash at hand. The average duration of the outstanding debt as of 30th of September was 14.9 years, with an average interest cost of 4.7%. And the average amount of debt maturing annually over the next 5 years is below $3 billion. So $3 billion a year on average for the next 5 years. So that's kind of like a minimum sort of rate you can expect them to be paying down the debt going forward. But I think they're going to be doing it probably at an over and above that, because as you can see in the next paragraph, an additional $600 million has subsequently been repaid, bringing the total debt repayment since the close of the merger to $11.8 billion. So they've already, in the last, I think, 19 months since the merger, they've repaid $11.8 billion of debt. And this takes you up to November 8th, I think. And so, yeah, we can probably expect to see maybe 6 billion plus repaid next year as well, or something along those lines. I assume they'll be and now that they have more, obviously there was some cash they had initially to contribute to that came with it that they could immediately repay. But there's they're, as we'll get onto in a minute, very healthily cash flowing. So there's plenty of free cash flow available that will be going forward to repairs. Certainly, like this year, as we'll get on to, is looking at about $5.3 billion. Certainly, that's what it's trailing 12 months, and what it will be expected for the full year of 2023. And hopefully that will be growing in 2024, as they're not having to spend so much on DCC to get it to this point. It's not a cost, it's not loss making. It's actually profitable now, and all the rest of it. But yeah, we're getting ahead of ourselves a bit. So the net leverage at quarter end was 4.2x, and management have restated their guidance that it will be comfortably below 4x by year end. They also highlighted the beneficial position the company is now in to retire its fixed rate debt below carrying value due to market interest rates having risen. So yeah, this implies more debt repayment before the end of the year as well. The possibility of a continued soft ad market in 2024 has led management to conservatively say their 2.5 to 3.0x leverage target might not be achieved until 2025. So yeah, this talk of a soft ad market and stuff like this is probably what spooked the market a bit, caused the plunge. But and we'll go through the segments a bit and to see how the network segment is languishing a little bit at the moment. But yeah, we'll get on to that in a minute. So looking briefly at the cash flows. So cash flows from operations were very healthy at $2.52 billion versus $124 million in Q3 2022, which flowed through to $2.06 billion in free cash flow versus a negative $192 million the prior year. This is also after they made their roughly $900 million semi-annual cash interest payment during the quarter. So, I mean, there's plenty of places they'll be benefiting from here. They'll obviously Barbie continued to do well through a lot of Q3. They had, so that really fueled a lot of this the cash flow I would expect. And then they've got they had Mortal Kombat 1, the continued success of Hogwarts Legacy, all the rest of it. So it's been a pretty strong quarter for cash flow. I think it's pretty good, a pretty strong quarter, the prior one as well. But yeah, so management is guiding for full year free cash flow to be around $5.3 billion, which matches the total from the trailing 12 months. So that's what I mentioned. So moving on to the studios segment, it's the first of the three segments being studios, networks, and DTC, direct to consumer. So the studio segment saw modest revenue growth of 4% to $3.23 billion versus $3.09 billion in Q3 2022, but a 5% decrease in adjusted EBITDA to $727 million from $762 million the prior year, due to higher cost of revenues and selling general administrative expenses. Increases in theatrical and gaming revenue have been offset by a significant decrease in TV revenue due to certain large licensing deals in the prior year and the impact of the strikes. So yeah, things have come off the board a little bit on these things. They haven't had as many the licensing deals and what have you, but what else was there? Yeah, TV. I think TV here is the largest factor for why things have dropped off, and I'm guessing a lot of that's to do with they've had a lower content slate as well, the stuff they've been able to license out and what have you. And a lot of this is due to delays because of the strikes. They pushed back releases of certain shows and things like that because they couldn't be promoted properly by the actors and so on involved in them, amongst other things. But management went into some detail on the company's gaming business, stating that it has been profitable for each of the last 15 years and averaging more than $400 million in EBITDA for the last 3. They also disclosed that Mortal Kombat 1, which was released during Q3, has to date sold close to 3 million copies. It sounds like they're going to be making further investments to grow their gaming business and possibly expand out into previously unexplored business models, such as games as a service and free-to-play. Finally, for studios, the Q2 opening of Warner Brothers Studios Tour Tokyo and continued strong attendance of Warner Brothers Studios Tours London and Hollywood have helped to increase other revenue by 5%, excluding foreign exchange. So yeah, I think from what I think they were talking about this in the prior quarter. Warner Brothers Studios Tour Tokyo is really attracting a lot of foot traffic. There's really massive queues of people every day queuing to go and visit. So yeah, it's I think they're going to be looking to expand their physical footprint of these kind of experiences, because they all do really well and generate good amounts of money for them, with the exception of the pandemic years when all kind of physical experiences were closed. So moving on to networks. Networks revenues decreased 7% to $4.87 billion compared to $5.21 billion the prior year, owing to declining viewer numbers and a soft advertising market. A smaller decrease in operating expenses led to a 9% decline in adjusted EBITDA to $2.4 billion from $2.63 billion the prior year. So 9% being greater than the 7% seen in revenue. So showing the operational leverage at play there. So yeah, the advertising is a big factor here, but there's obviously going to be this is a declining business, so there is going to be this ongoing decline in viewer numbers over time anyway. But I think the having advertising on top of that just accelerated things a little bit more. But I mean, it is one quarter as well, so better to look at these things on an annual basis to really try and get a better picture of the what the overall declines are over time. They're expecting an incremental improvement in ad revenue in Q4 as a result of the strong deals they secured during the upfronts this year and improving ratings trends across some of their core networks. There's been quite a bit of noise around the deals signed between Charter and Disney, which resulted in several of Disney's channels being dropped. When asked about it during the earnings call, Warner Bros. Discovery's management seemed pretty happy with the structure of the deal and don't appear to be overly concerned about the prospect of some of their own lower performing channels getting cut in return for boosted subscription revenue for Max. So I think the idea, I looked into a lot of the details on this, but I think the idea was previously Disney Plus was kind of getting bundled in to the cable subscriptions to some of the Disney channels. It was getting given for free previously, and now Disney said they want basically people to pay an extra fee for the Disney Plus, so it's not just a bundled in for free. But Charter wasn't particularly happy with this. They wanted, and so the deal that they ended up reaching in the end was to cut some of Disney's channels. They were not going to pay for those, and then still having the Disney Plus as an extra add-on thing that was the additional fee on top that was paid. So kind of like balancing out a bit there. But I think when asked about this, Warner Bros. Discovery's management said there were definitely some lower performing channels that they would be prepared to lose when it comes to them renewing deals and so on. But they actually see having an additional streaming product on top of that as being a positive thing. And they also were talking about, and I'm not quite sure exactly how this, but I think potentially something like Charter or whatever, having a bundling sort of package where they provide the option, several different streaming platforms all together in one single bundle product. And Warner Bros. Discovery's management seemed pretty positive and liked the idea of this kind of bundling approach, which moving back, I guess, to the cable model of having all the channels and so on. So yeah, I do think it does seem to be that they're not overly concerned about this. Maybe we'll have to see how it goes from here, but I think having boosting the subscribers to the direct to consumer, which is really the future of where things are going to be going, sounds like a better thing, even if it reduces some of the money from networks. Having that sort of just larger base of DTC customers is probably a fair compromise, and it gives a decent sort of enough balance. But yeah, there's still some shorter term downside here if they lose some of the network revenue when it comes to renewing some of these things, as they lose the payments for some of these smaller channels and so on. Yeah, hopefully this will be offset by growth in DTC. So direct to consumer revenues increased 5% to $2.44 billion from $2.32 billion the prior year, with a notable 29%, excluding foreign exchange, rise in advertising revenue to $138 million from $106 million, driven by growth in the Max Ad Lite tier and higher engagement. So positive if you've got more people spending more time on the platform watching more stuff, then obviously the ad payments a certain portion of them are going to be linked to number of views or whatever, so they're getting more viewed, even if they're not getting more subscribers, or they are still saying here that they're getting growth in the subscribers to this Ad Lite tier. The higher engagement helps to drive higher ad revenue as well. And the really big thing is, so the revenues grew modestly 5%, but operating expenses fell 21%, excluding foreign exchange, to $2.33 billion from $2.95 billion, largely due to lower content expense and more efficient marketing-related spend. This resulted in a dramatic swing from adjusted EBITDA from a loss of $634 million in Q3 2022 to a profit of $111 million in Q3 2023. So it's broken into profitability, as it continuing from where it was the prior quarter as well. There was a modest drop in total subscriber numbers from 95.8 million million subscribers in Q2 to 95.1 million in Q3, but average revenue per user, or ARPU, rose to $7.82 from $7.71 the prior quarter. The drop in subscriber numbers is apparently due to a lighter content slate, in part due to show releases being postponed due to the strikes, and some overlap between Discovery Plus and Max subscribers. So there's still an ongoing effect from in Q2. We had the release of Max, and this included a lot of the Discovery content. So therefore, people who were subscribing independently to HBO Max and Discovery Plus now are going to, or people who were, there's just that merging there of the two as because of the overlap. So, because people who would pay in additionally for Discovery Plus can now just pay for Max and get the same content. But yeah, it's positive to see that ARPU is increasing. This is across both the domestic and international. Domestic is significantly higher, but I think that a lot of the international stuff is like South America, and it's other markets that aren't as the income levels aren't as high. But yeah, it's there, and yeah, just so the next bit I was saying here is that now they've got the DT segment to profitability. They're looking to start investing in growth through international expansion. This includes launching Max in Latin America. So I think they already have HBO Max, and a few of these, the ones I'm going to list here, they already have HBO Max there, but they're going to be now releasing the combined Max product. And then there's also some other ones where they maybe have Discovery Plus, or they don't have either the products available, and so they've just been licensing out the content to other providers, like the UK as an example there. Though we do have Discovery Plus, we don't have HBO Max or anything, so we have to use other streaming platforms or whatever, or buy the content on demand or whatever to get some of the shows and films. But yeah, this includes launching Max in Latin America in the first quarter of 2024, then the Nordics, Iberia, the Netherlands, Central and Eastern Europe, France, and Belgium later in the year. So quite a bit of international expansion going on in 2024, which should hopefully help to drive up the subscriber numbers next year, and hopefully ARPU as well, especially as some of these are more developed markets they're going into, where they could charge higher prices. And I think they currently cover something like they're present in some form, which I think also includes Discovery Plus, in some markets representing about 45% of the world's like broadband customers. So broadband paying households. So they've still got like over half the world's population to target, and like I say, quite a lot of those markets, I think, where they mentioned there, they don't actually have their main like HBO or Max products. They just have the Discovery Plus at the moment or something. So or vice versa. So the new having Max is not available in all those 45% as yet. Other markets like the UK will probably see launches from 2025 onwards when their current content licenses expire. I think Germany also fits into that category, and quite a few other European ones. As I've previously covered, live sports and news came to Max in October through the Bleacher Report add-on sports tier and CNN Max, respectively. We'll see in the coming quarters whether they have helped subscriber numbers and churn. So yeah, it'll be interesting to see that. So the sports add-on tier was being added as initially free, I think, for the first few months or something, till January maybe, or something like that. And then it would be an add-on tier for people to pay for if they want to get this. They'll then have to pay the additional fee for it. So that providing it for free for a period of time is obviously an investment as well. And CNN Max, there's some interesting stuff about it helping already, them seeing early signs of it helping to increase engagement, because you've got people who were previously not really using Max that much. They're watching a couple of shows or whatever a month or something. Now having just with all the events happening in the Middle East and so on, and other parts of the world, getting the news on, using Max as the platform to view some of these things, and just having it on in the background, and a lot more engagement. And these are people that were not paying for cable or anything like that before. They're sort of, I think the average viewer of CNN Max is 20 years younger than the average viewer of CNN on cable and so on. So yeah, it's hitting a completely different demographic, which helps to avoid pulling people away from the cable products or whatever. It is hitting a completely different group of people. So yeah, that's pretty much sums up the earnings and what I sort of took out of them. I think looking pretty positive. Everything, they're on track to meet all of their guidance, all of their forecasts for things. You know, the debt is being paid down at a very strong rate, accelerated rate. In fact, I don't think they were expecting to reach this point as yet. They've got DTC is profitable a year early. You know, everything's really making on track and making good strides. So yeah, I think we're in a pretty positive place, and I like to see now that they're looking to start investing a bit in, now that they've taken a bit of the financial pressure off themselves and they've got the debt a bit more under control, and now got a clear trajectory to continue paying it down to the sort of 2.5 to 3x range within maybe another 18 months, let's say 18 months to 2 years or something, to get really just down to that really comfortable level. You got a bit more breathing room, and they're now able to start investing a bit, and with DCC being now breaking even as well, so it's not just bleeding cash. Getting to this point has allowed them now to have a bit of breathing room to invest in growth into the gaming business, which they see as really attractive, and they talked quite a bit in the earnings course. Worth a listen to if you're interested in hearing about that. And then in the DTC as well, just the international expansion. Max is, like I say, the UK being one example. We don't have Max here, so it's a big market they can hit, and there's many more across Europe and the rest of the world. So plenty more to go after. And now that they've worked out, now that they found a way to do it profitably, it's a great base from which to now grow. So we'll see. I have to see how that goes for going forwards. But another bit of good news is that not long after the Warner Bros. Discovery earnings release, we heard that the SAG-AFTRA strike, which is the actors union, would be ending on Thursday, the 9th of November, which is last Thursday, with a deal having been struck with the studios pending a vote of the union's board on Friday, the 10th of November. And that has subsequently passed with 86% of board members voting it through. So yeah, hopefully this draws a line under the disruption and allows Warner Bros. Discovery and the other studios to get their content production and release schedule back on track. So yeah, it's real positive, and now everyone can take all these students to start actually properly solidifying a release schedule for next year and beyond, and production schedules as well, and so on. So yeah, it's all positive. We still do have a little bit of a potential risk with some other union action next year. With, as I've mentioned before, with the kind of the union that represents all of the backroom, off-screen sort of stuff. I believe it includes things like CGI, all the set lighting, sound, all the rest of it, personnel. So yeah, that is a bit of a concern there, but and it's certainly potentially bigger than the writers, maybe not as big as the actors, but yeah, that's a potential like little tail risk for next year. But hopefully, with the mold now in place from the 2 deals that have been struck so far, any disruption that does happen when that contract becomes to be renewed in, I think, August next year, it will be resolved quickly. But anyway, I think that will do it for this episode. So yeah, go read this newsletter over at firmreturns.com. Sign up there for free, get it in your inbox, what have you. The Firm Returns Weekly newsletter, if you wanted to choose different ones. Also do longer form write-ups. I haven't done one for a while. The last one I think was a big update on Tiny Build. That was probably back in July, August time. So yeah, it's been a little while since the last one, but largely because I've been putting quite a lot of time into doing the weekly stuff. But yeah, I'm looking to do some new write-ups on other companies going forward. There's also portfolio updates. So every time I buy or sell anything, I'll put an update out, normally the day I do it, at the end of the day. So yeah, if you're interested to see, having seen me talk about these companies, to see what I'm actually buying and selling and hold myself, you can get those in your inbox as well, or they're just available on my site here, portfolio updates. So you can see I actually bought some more Warner Brothers Discovery on the 9th after the shares fell. I got it picked up for an average price of $9.64 per share. Yeah, so give that a look. You might be viewing this on YouTube. They also have podcast versions of the episodes, so you can go have a look at those. Should be available on all your major podcast. They're not on Apple, but they're on Spotify, Amazon Music, Google Podcasts, etc. The ones that are easy for me to distribute to without needing to sign up to get an Apple account and stuff. But yeah, so give all that a look. And I'll see you all in the next episode.